First of all, thank you so much. First of all, thank you to Ingrid for putting this amazing panel together. It's a real honor to be part of it. So I don't have slides, and I will focus on a few research subjects. Hopefully it will be clear. I first wanted, so I do research in a couple of areas. A smaller piece of it is in private equity. Jakob by far is a bigger expert in private equities than I am, but I wanted to add a couple of thoughts on private equity just to build on what Jakob already said. And one thing is that you should think about private equity as a continuation of corporate finance topics, because if you think about what private equity does, especially, so if you line up the spectrum of private equity, because private equity is a big term, right, and pretty much everything that is not public equity ends up being private equity, and it doesn't even need to be equity, frankly speaking, so that's, but if you, the core buckets of private equity, the baby stage is venture capital, of course, then you have growth equity, and then on the other end, dealing with public companies and some private companies is a buyout industry, right? So, and they're very different, it's a very segmented industry, so what they pursue is very different. But at least on the buyout end, and venture capital and growth equity, the way the industry is run is that the investor, the private equity plays primarily financial intermediary role. Whereas on the buyout spectrum of it, they are very hands-on. Any large firm you can think about, they have an operational team, and it's much about transformation and turnaround of the company. And oftentimes the management stick around. Obviously, if you're an entrepreneur in venture capital, you're definitely sticking around. Those are your ideas that are funded by the venture capital. Growth equity, it's again, private equity invests in people. You don't bring your own management. In the buyout space, however, management is can stick around or can be replaced, because now there is a full control, and the buyout space is about, as I said, turning around the company. And that in that space, it really becomes a corporate issue, because the very premise here is that the private equity firm, the buyout firm, somehow will be able to run this company better than whoever was running it before. And at that point, it's a corporate issue, right? Of course, private equity has a finite horizon by definition. That's one characteristic of the private equity that does stick around. And so there are other elements such as an exit, either it's an IPO or a merger or whatever, which is also a set of corporate issues beyond just private equity. So running the company right and taking financial decisions, capital structure, exit, dividends, recaps, and all of those, these are all hardcore corporate subjects. So you think about, even if you end up doing corporate finance, private equity is probably in your sample. Just keep that in the background. So if private equity seems like, oh, this is too esoteric, this is not for me, this is the reality. This is the reality of the corporate segment. And it's actually a fascinating reality, right? Because, as I said, it's not so obvious what is it that the private equity brings into the table. Why they're able to run companies better. And here's another thing. About 40% of exit from private equity is sale to another private equity. So now you have an issue of like, wait a second, so not the first private equity, well, they were visionaries, they could run it better than the people who were not private equity. But now the second round of private equity, well, they have to create value somehow again, right? So this, and 40% of private equity is that, right, of buyout space. So it's an interesting issue of thinking about what is the source, and one of the big buckets of research ideas, the big umbrella, the question that creates big umbrella is what are the sources of persistent value creation in private equity? Now, I alluded to one of them, which was relating to employment, but really we have a very scattered picture and little understanding. We are much better at cornering it from, is there a outperformance in private equity? And thanks to the data that have been much better in the recent years, we have a much better sense of what's going on there. But still, getting our hands on what is exactly they're doing and how comes this is a persistent source of value is very important. Now let me just transition from that into my main area of research, which relates to financial intermediation, financial stability, by elaborating a little bit more on the subject that Ayako alluded to, and that's and I saw that in Laura's talk it was also in the background, in the fact that not only the alternative asset classes, and a big chunk of alternative is private equity, is more accepted, we understand it better, we can measure performance, we have a better grasp of what are the standards in the industry, although there is a big room to go. But it's actually, in the recent years, became kind of a necessity for big groups of investors out there, asset managers out there. And specifically, we've had 10 years of extremely low interest rates. So now if you take public pension funds in the US, or in Canada for that matter, they are underfunded, and that's the big topic in the pension funds system that relates to the Laura's talk. So the issue of underfunded is that their defined benefit is that they have a promised interest rate that they promise to deliver to the retirees. Now, because of the structural shifts in the past decades in the interest rate environment, and because of the demographic trends, it's very challenging to deliver the 8% or so, which is what they are targeting for their benefits. Historically, it was in an inflationary environment, it was delivered by putting much of your portfolio in a fixed income, and that is relatively low risk and a high return. Now, you can no longer do that through the fixed income, because of what we just said, 10 years, and nothing is happening in the system. But you under pressure if you are a public pension fund to generate that return. And again, US or Canada. And so with that in mind, there was a bigger push into alternatives and private equity specifically as a source of potential generation of those returns. Now, if you talk to the practitioners who are doing these things, their view is, look, I don't know if this is a good idea or a bad idea. Fingers crossed it's a good idea. Fingers crossed for all of us. But what it is clear is that you no longer can do what you used to do several decades ago. So you can no longer generate the return existing income, and that forces you into being creative. And that brings a lot of issues of, all right, one way, so the issue with private equity actually is that, and as alternative asset classes, it's not that whether it generates alpha, but it's also about the subject of how that alpha is distributed. Whether it goes to the intermediary, the general partner, the Steven Schwarzmans of the world, or does it go to pension funds, right? And so there is joined with this, okay, we're going to shift into alternative asset classes. There is this element of we're going to gain the bargaining power to be able to extract the bigger fraction of an alpha for us. And there are a lot of interesting things going on in the pension funds, thinking about how can they generate that return, how they can interact with the alternative asset classes space, directly or indirectly. Some of them are trying to pursue these things directly, to get a higher return, to maintain this promise of the returns on defined benefit funds. Now, this goes even beyond defined benefit issue, because actually if you think about defined contribution or generally financial intermediation space, what you observe is that there is this pressure due to competition. If you are a private pension fund, you're subject to withdrawals. I personally can choose among 3 different managers, and within each of those managers I have options of which fund my money goes to, and so do many other people. And so there is this pressure of, okay, well, this extra elements that they can generate, extra returns that they can generate, that also pushes them away from low interest, in the context of low interest environment, from fixed income and into trying to do other things, which brings us this important issue of ties to the point about why this understanding alternative asset classes is so important. And of course, this phenomenon of trying to push into slightly riskier elements, riskier investments is what we tend to call reaching for yield or searching alpha. Reaching for yield is by definition associated with fixed income, although we broadly use it in general, so searching alpha is a synonym of that. So to me, this subject of reaching for yield, it ties directly to pension fund. It ties directly to the fact that alternatives becomes a more important asset class. And it's of course a broader subject that we need to understand. So the broad, again, umbrella on the reaching for yield is that there is a sense that reaching for yield is something that ties to the monetary policy that tends to emerge in context of long periods of depressed interest rates. And this is a second period of long period of depressed interest rates that we are going through. So there are several questions there, right? I mean, well, first, is this true? Is there a relationship between monetary policies, depressed interest rates, and elements of reaching for yield throughout the economy? I alluded to one of them, the pension funds and shift into the alternative asset classes is one manifestation of it. But it manifests itself in different places in different ways. It's just broad phenomena that grows through financial intermediation. So one is it tied to monetary policy? There have been people who try to tackle this question. Here's the reality of it. We don't have enough observation. This is a time series question. It's out there. The evidence of pinning down this question, is there a causal relationship between them, is one of the key questions out there. We believe it does. There is some suggestive evidence, but guys, it's out there. Hopefully, one of you might be able to say something to us that will finally put a conclusive flavor to this question. Now, beyond that of what is a causal relationship, the other point is, okay, well, can we measure it? Where does it manifest itself? How does it manifest itself in an insurance company? How does it manifest itself in pension funds? How does it manifest itself in high yield mutual funds? All financial intermediaries, in one way or another, are sensitive to this reaching for yield, searching for alpha. And it's important for us to understand who are the key players out there that are sensitive to accumulation of this mismeasured or mismanaged risk. And this ties to an earlier point about the fact that this is the world of this financial intermediaries is an actively changing world, and you have to keep understanding that where does the risk will be accumulated, because we are kind of in a mode of putting fires off, and every time we put one out, there is by definition, what we tend to call shadow banking, which just means something that is outside of regulation pops out. And so understanding where that risk goes, where is it accumulated, that's one, and within this reaching for yield umbrella is another important question. Now, beyond that, so one is measurement, but another element here is fragility, because it's not enough that this risk is accumulated. Is it fragile? So, for example, insurance companies, this is very interesting, and there is a substantial accumulation of reaching for yield. But how would it react to reversal of the monetary policy stance? And so, is it ultimately introducing fragility into the system? So this is a question that are very relevant in reaching for yield phenomenon, and it changes over time. Different institutions play different significance in different periods of depressed interest rates. So to me, this is the umbrella of reaching for yield, and this is the element that I think I'm eager to learn about, and hopefully there will be. So if I see paper on that, I will be delighted to read it. Now, another subject, unrelated subject, that emerged post-financial crisis that we really don't know much about, and I think that there is a big demand. So an unprecedented phenomenon that we observed is that, well, covered interest rate parity violation. So, two interest rates around the world are never the same, but guess what? By the time you converted your funds into the currency in which interest rate is the highest, and you hedged out the risk of the fact that you ultimately will need to go back to your currency, that profit should disappear. Well, in major currencies, this was a fact. Any international course would teach it to you as a fact. He would show and would say, look, this is one thing that we know about the world that is always true. Well, it's no longer true. So you take euro, you take yen, you take dollar, and it just, since 2008, it's all over the place. And we don't have a conceptual framework for thinking about, well, why is it not there? Because these are very liquid markets, and we always thought that, this is due to liquidity and there are some market frictions, but now we are looking at major currency, and there is this big disruption. Now, there is a sense that this disruption is actually attributed to changes in the banking system and financial systems that surround the banks. And the fact that we observed it after the 2008, late 2007 episode seems to line up with the fact that, okay, banks do things differently and they face different constraints that seems to complement this element of new context in the interest rate and exchange rate world. But again, we don't know how to think about it. We don't know. So there is a theory part, there is an empirical part. Is it a big deal, the fact that the violation doesn't disappear? What makes it spike? It's really like an open arena. And I think that it's really fruitful and it speaks to some of the core elements, not only finance, but also in economics, and there is a big demand for understanding the question. I'm going to identify very quickly one third area, and that surprisingly we understand little about, and that's differences in banking models. If you think about large banks versus small banks, so this element of consolidation of banking that was out there in the 90s, early 2000s, there was a wave of bank consolidation, and we were thinking about, well, does it matter, what consequences are there? And we kind of let it go, the world didn't change that much. There are some interesting things that were said, but post-financial crisis, the world emerged with a very different model, and it's more than ever pronounced a segmentation of the banking industry. And frankly, we don't understand very much why is it. There are some suggestions, there is soft information, there is a wholesale funding access. So those are very interesting thoughts, but more broadly, we don't really understand the consequences for the conditions and supply of credit that it means, as well as there are consequences on the deposit side, and there is some interesting research that's already being done in terms of servicing depositors from the large banks and small banks. So just to reiterate, I think that private equity is definitely a fantastic area for research. It's an area that will inform us, and there are a lot of things to like about private equity, but it will also inform us about corporate subjects that we should all care about. On the financial intermediation, there is really a sea of subjects, and a few that I focused on. One is reaching for yield, and as I said, there are elements of understanding why people reach for yield. Can we measure reach for yield? And then there are some institutional aspects of understanding who's reaching for yield, are they fragile? And the other things that I mentioned is banking model, which is one of my favorite, and the CAP, which is truly puzzling to many, many people. And I'm hopeful that we'll figure out in the next couple of years what it's all about.
Thank you so much.